Well, hi everybody, welcome to our mortgage live stream. We're live streaming here live from Cheltenham, Gloucestershire. I hope everybody's well. It's a horrible day out there. It's pretty much yucky. It's chucking it down. It's been a horrible weekend actually, but we've got some topics this morning that will brighten up your day, or this afternoon I say, because it's on the hour. Noon seems to be a good time to do these live streams. So got a few topics for you today to interest you. Some updates, a few little extras on second charges, got that coming up for you as well. And if time allows, a little bit of work on council tax reduction. But if that doesn't time allows, then we'll do that the following week. But what's been going on in our sector? Well, not a lot really. The stamp duty thing's doing its required desire. I mean, looking around Cheltenham, there's for sale boards going up everywhere. So people are obviously trying to sell their properties. Which is good actually in a way, because not only will demand go up, supply will go up as well. So I don't think we'll see too much going on with prices, because obviously if demand goes up and prices remain the same, supply remains the same, then prices start to go up. So we don't want to see that, do we? Because what the worst thing, of course, is if there's a massive, great big bubble that bursts come sort of February, March next year. But it's good for the sector. What else is good for the sector, which not a lot of people know about, is we've got a new guy at the helm of the FCA. We've got a new person, I should say, at the helm of the FCA. And I'm not going to say girl or guy, because at the end of the day, that's what this is about. His name is Nikhil Arati, who is the new Chief Executive of the Financial Conduct Authority. And Nikhil performed in front of the Treasury Select Committee in order to be vetted for the job. And we're asked about what they're going to do differently compared to the previous incumbents of this watchdog called the Financial Conduct Authority. And this is where there's going to be some lovely changes, I think, to the sector. The first thing that was said is that they're going to focus on mortgage prisoners, which I think is a great thing, because there's an awful lot of people who are stuck in a mortgage that they can't get out of because of legacy underwriting. And they're being charged ridiculously high rates of interest. And there's quite a few million people stuck in that situation. And the watchdog said they're going to sort that out, which is great news. The second one, which I like a lot, is they're going to the FCA, are going to intervene in the industry if it doesn't sort out its diversity. Hey, about time somebody said that as well. This financial services sector that we're involved in isn't very diverse. It's not. It's one of the oldest fashioned industries you could ever imagine, which is completely dominated by certain sectors of society, which is totally and utterly wrong. We've got new people trying to come into the industry sector, which I talk to every day. They come on my boot camps, young people. New people with new ideas, fresh ideas. And they come across this brick wall of the way it's always been done. And diversity's not there. I mean, it's typically white, sort of middle-aged, older men, bald men in our sector. Females need to come into the sector. We need to be dominated more by females, less testosterone, if you like. Get rid of this laddish culture that seems to be around in financial services, this sort of male-dominated laddish culture. Got to go. And I think if Nikhil can sort that out, can make this industry much more diverse, I think it's a great thing. So watch this space. I think it's a lovely, lovely, lovely idea. So good luck along the way. What else has been happening then? Well, read about lasting powers of attorney. Now we know what a lasting power of attorney is. Let's put the topic up there on the board for you. Lasting power of attorney, which is beginning to become quite popular amongst people, and it should do really, because a lasting power of attorney is absolutely essential element in order to look after people that are growing older and greyer. Now my old pops, for example, he lives in France, he's 82 now, and I've been banging on trying to get this lasting power of attorney set up with him so that I could look after his affairs. And that's of course what the lasting power of attorney does. It gives me, just one of two sons, unlimited authority to look after my father's health and well-being. There you go. Health and well-being. And his financial affairs. There's two types of LPA. Health and well-being and the financial affairs. There's two types of LPA, which we'll talk about how to do it in a second, because that's what's changed here. And it gives me the ability to look after my dad's health and well-being. So, if he needs a care home or some private care, whatever it is, and he's unable to look after himself, then I have unlimited authority to be able to deal with that. But also his financials. He owns a property in France, he's got state pensions, so it allows me to deal with his financial affairs if he is unable to do so. He's still alive, of course, but he's unable for whatever reason to handle things, and that's what the LPA does. Now, many people don't have LPAs because it's too much faff, it's too much legalistic language, isn't it? But no longer now, because the government have introduced a new website. I've got the link here if anyone's interested, but just Google it. It's a government website whereby you can set up an LPA really, really simply. And I think that's a great thing. You go online and you key in the details, you pay your money, it costs £82 per LPA, 82 for that, 82 so it's 160 odd pounds. You can actually have that money reduced if you're on any kind of pensions credit, or if you're on any kind of support from the government. You can have that money reduced if not down to nil, so it may not even cost you anything. It's easily done. I'm going to get it settled up finally once and for all with my dad, so that I get an LPA set up in his name. So I think that's really good. You don't need legal advice for this. You don't need to go to solicitor and be charged 500 quid for all these things. It can be done yourself, and why not? That's exactly the way the world should be going right now. Very useful in the later life market, of course. If you're a mortgage advisor, you definitely need to be recommending your customer has one of these. In the later life market, even if somebody's not doing equity release, if they're borrowing into a later life, say 75, 80 age limits now are stretching remarkably, make sure they have an LPA set up so that the people in their lives can look after their affairs if things start to go wrong. So definitely something to look at, and I think it's a really good thing. So that's lasting power of attorney. Nice little update there for you on that one. Good stuff, isn't it? All this modernisation of websites and stuff. Trying to avoid making things complicated when they don't really need to be complicated. That's the whole point about it. I think our sector's pretty damning that we try and make things more sort of complicated than they need to. Another update for you on national savings and investments, NS&I. So let's put the title up here for you. National savings and investments. And I call this one post-COVID, which sounds awfully awful, if that's the right phrase to use. Post-COVID. National savings investments, of course, if you've studied those before, you know that these are the investment accounts offered to the British public by the British government. And you and I can toddle off and invest our money into national savings, risk-free pretty much investments in which the government sponsor it. So the whole point behind it then is that the government guarantees any investment in national savings. So here's where the differences have occurred now, because as you know, you have the government scheme where it guarantees a certain amount of your money on deposit with building societies and banks, whereas this money is completely guaranteed up to £2 million. They've increased the limits, and that's what I want to talk about here. So it's a complete government 100% guarantee, and that's what they've done. You see, they need this money because they've got an awful lot to pay back with COVID. That's the whole point about COVID, is that we're spending millions, billions of pounds in trying to keep the economy going with furloughing and injecting money into various industry sectors. You've got self-employed being looked after and all sorts of things as well. Even the £10 dinner thing they're doing in August is money that the government's providing. It's going to be paid for. Government gilts, of course, are doing the majority of the paying, and the Bank of England's printing money to pay for these things. But national savings, they've increased the limits. What they've done is they've whacked the limit, or the most that they'll look at taking on this year, to 35 billion. Now, typically, it's around the 10 or so billion pounds is the most they'll let in to this exclusive club. But now they've whacked it up to 35 billion, which means that there's plenty of people who can invest their own money in national savings. So why would you do that? Well, first of all, you've got the government guarantee up to some products up to £2 million. But the best thing is the interest rates are really competitive now. They've increased the interest rates slightly. And there's three main accounts really in your syllabus, in your exams, that you'll be tested on. The first one, the most popular one, is the income bond. Now, the income bond pays you an income. Obviously, that's why it's called income bond. But the beautiful thing about them is really popular, pays a really good rate of interest compared to the marketplace. and you can get yourself a good amount of income from that one. The other popular account is the Direct Saver. Now the Direct Saver, yes, there's plenty of competition from banks and building societies for this kind of account. Of course there is. It pays a reasonable amount of interest. But the good thing about this one is it's dealt with online, so you just go online and deal with it. It's no big deal. But you can put up to £2 million in this. So that's a hell of a deposit you can pay into this one and have it all guaranteed by the government, rather than just the old 75,000 figure for banks and building societies. The other account you need to be aware of is the investment account. It's still around. This one's been around for donkey's years. The investment account. Now the investment account is only up to 1 million. Only, he says. It'd be nice to have £1 million to put on deposit, wouldn't it? But this one's post only, so you have to do it by post. It's a bit old fashioned, this one. Now there's no certificates yet. The certificates, the certs as we call them, are not available. You should be aware about how these work. These are the tax-free investments which the National Savings have. They call them certificates, and they offer a tax-free rate of interest. The other products are taxable, unfortunately, but certificates are not available, mainly because they don't need to put them into the market to drum up business. There's plenty of money the British public have got to invest, and by having a government-backed guarantee and a decent rate of interest, it's enough for people to put their money into these products. So there's nothing wrong with that. So that's National Savings, a little bit of an update for you. Hope that's been useful. Okay, so nice little topic, that one. Lots of little topics today, which is good, isn't it? Let's just take a look at another topic, really, which is relevant, I suppose, but one which causes a little bit of confusion, but something that really makes a big difference to the way that you operate. And this particular topic is for those people dealing in the equity release marketplace or the later life marketplace. And I'm calling this one the council tax reduction. So let's put a title up here for you: council tax reduction. Now, for those of you unlucky enough to pay council tax, I suppose you're lucky in the fact you own a property, so that's a good thing, isn't it? But unlucky enough to pay, it's a lot of money. Now, I pay Cheltenham Borough Council here. What do we pay? A couple £100 a month on council tax. It's not cheap. It's one of the bills you have to pay. Such is life, the way it works, isn't it? But as you get older and greyer and your income starts to fall and you start to just rely on a pension, for example, there's all sorts of benefits of which you can take on, such as pensions credit, for example, to boost the money that's coming in. But there is a thing called council tax reduction, which the government sets the rules in which local authorities can let you off your council tax. Now, if you're dealing with somebody in the equity release marketplace, you need to be doing a fact find on them to make sure that they are either receiving this or could be eligible to receive it. You're not going to be a benefits consultant and give them advice on their benefits, but you need to be aware of what they're receiving in case the advice you give knocks on the head their eligibility to receive that benefit. That's the key reason why you need to understand how these work. They're all different. You have to go to your local authority who've got all the different situations, and they've got websites which outline it as well. But we do need to give you a basic understanding of how it works. Now, first of all then, there's two ways in which you can qualify for council tax reduction, or CTR. There's the pensions credit route, and then there's the income assessment route. So two different ways of doing it. So let's put those up on the board for you. The first route is the pensions credit route. And the second one is to have your income assessed. So there's two broadly different ways of getting your council tax reduced or eliminated altogether, which would be rather nice, wouldn't it? Now, the pensions credit route is fairly straightforward. If you get the guarantee part of pensions credit, then you're going to get a full reduction on your council tax. Easy peasy. And pretty much everything else is ignored, really, if you're getting pensions credit. Now, the beautiful thing about pensions credit is that your income is very low, and therefore the government tops you up to a certain figure per week. For an individual, more for a couple. So if you're getting pensions credit, you're pretty skinned. Let's be honest about it. You're pretty broke. You haven't got a lot of money coming in. Because the whole point about pensions credit is it looks at all your income sources, and if it's below a certain weekly figure, they give you this credit to boost you. So it's for people that really are skinned and they need every possible help they can have. And if you're getting pensions credit, you're going to get a council tax reduction in full. Well, that's just the way it goes. It's just easy to work that one out, isn't it? You do need to be a bit careful with people who've got capital, though. If you've got so basically pensions credit, you get a full reduction, as we said there. But you've got to be careful with people who've got capital, money put away. And the rule generally is, if somebody's got more than £16,000, they're going to start to lose any council tax reduction. And that's sensible. It's between 10 and 16,000, you start to lose it. And they work out a notional income of £1 per week for every £500 that you have, and they use that to work out your pensions credit as well. So really what I'm saying is, if you've got money in the bank, the first thing they'll do is they'll reduce your pensions credit anyway, and if that's the case, you're not going to get council tax reduction. So that's something to bear in mind. So be careful then when you give your customer a lump sum in your equity release transaction. If you give your customer a lump sum, then that in itself could create capital, because they'll put it in the bank. The council will assess that. If it's above 16,000, you'll start to lose both your pensions credit and your council tax reduction as well. Pensions credit has a different calculation when it comes to losing that. So the 16 grand limit is something to think about there. So that's fine, that's pensions credit. The second way of doing it is through assessing your income. Now, if you haven't got pensions credit, you can still qualify for some element of council tax reduction by having a look at your income compared with what they call the applicable amount. Now that's worth jotting down, the applicable amount. Let me put that down in black there for you. The applicable amount. Now the applicable amount, I've literally kept that quite sort of sparse, or I've not mentioned what the figures are, because it doesn't change according to your situation. The applicable amount is the amount of money that reflects the basic living needs of the person who's claiming for it. So in other words, how much should they be earning in their situation to be able to basically live? It's kind of like a salary figure, this applicable amount. You need to go online to work it out. It's not easy. How old you are, how many dependents you've got, those sort of things. You key in all the details, and it gives you an applicable amount. So it does vary from situation to situation. Broadly speaking, if your income is below that applicable amount, then you may be entitled to some council tax reduction. Makes sense, doesn't it? If your income is above the applicable amount, then you ain't. I suppose you could argue that the pensions credit's already done that, because pensions credit has an amount of money, and if you're not earning that through your pensions, they'll top you up to that limit. So the two kind of go together in a way, don't they? But what you've got to be careful of, though, is a thing called taper adjustment. Oh, I like that phrase, don't you? Let's put that in red, shall we? Taper adjustment, which will adjust the amount of council tax reduction you're getting according to your income. So what they say then is they reduce your council tax reduction by 20% for the amount of income above the applicable amount. So any income you've got above the applicable amount, they will reduce your council tax reduction by 20%. So if we take an example of Mary, Mary's got a pension £40 a week more than the applicable amount. So let's just put in there Mary. There's Mary. Mary's got pension income of £40 a week above the applicable amount. There you go. Above that. So she'll have her council tax reduction reduced by 20% of this. So 20%, let's put the figure there for you. 20% of £40 in my book is £8. So she'll have her council tax reduction reduced by £8 because she's got income £40 above the applicable amount. That's pretty much the calculation they use, and that's in the textbook, so you do need to know how that works. So just remember the 20% of anything above the applicable amount. You won't go far wrong with that really when it comes to it, so be careful of the taper adjustment. It is complicated. There's no set ruling for this one. It does depend on situation, so you do need to sort of get down there and have a little look. But the key message for equity release advisors, though, is don't take into account that they will lose this, or don't forget they might lose this if you give them money. Now, with equity release, most people get lump sums. The lump sum is then used to buy stuff like give to the kids or pay for a house improvement or something. If you start giving people lump sums, then that in itself can create problems of getting pensions credit and stuff like that. Of course it can. You've got the 16,000 limit. But if your equity release product you're giving the customer increases their income, so you get an income-based equity release, that will cause problems, because it may well be that their income is above the applicable amount that you've given them, therefore they start to lose this council tax reduction. As a result of you giving them money, they've lost this council tax reduction, so you've given them one amount of money and the government have taken away that money through losing benefits. You've got to be very careful with that one. So when you do your fact finding with the client, you have to make sure that you get all the details of the benefits they're claiming. And if you think they could claim for something they're not getting, then tell them to go down to the Citizens Advice Bureau and get some advice on it, or go on the DWP website and get claiming. Yes, you should do that. Of course you should. But when you come to give the advice, you've got to go online. There's various companies that will sell you software which will work out the impact that your advice is having on the customer's benefits that they're receiving, and that's going to be printed out and forms part of the suitability letter that you give to the client, because it could well be onerous. Imagine the complaint you get later if you've mucked up somebody's council tax receipt, pensions credit by giving them income on an equity release. That won't go down very well at all. So make sure that you get that right. You can buy software that does this for you, that works it all out, which is what you should do. It's the right thing to do. So that's council tax reduction, available from your local authority right now to help you out in your time of need. Hope that's been useful. Bye. Great, you like that one, did you? So useful topic. A little bit of an update for you then on the mortgage syllabus. Remember, if anyone's interested in our boot camps, got one starting today actually. Got the late autumn cohort, as we call it. So there's a few spaces on that one. You can contact me and we'll get you on that for your full CMAP. So get your CMAP done by the end of the autumn. That's what we call the autumn cohort. So we kind of encourage you to get it done within a 4-month period. The cohort or the boot camps, loads and loads of videos like this, all in sequential order, showing you how to pass the topic as well. So keep in touch with me, ping any questions you've got. Remember to subscribe down there on YouTube, unless you already have, and we will be catching you next week here in Cheltenham, UK. See you next week. Bye.